Hello guys, in this video I'm going to share trading strategies based on price action. This means I'm not using any indicators at all. So if you want to learn more about this, make sure to watch until the end. And don't forget to like and subscribe to the channel, so you don't miss new updates. But first, remember to like this video and subscribe to the channel if you'd like more high quality videos like this for free. I'll see you right after the intro and disclaimer. In simple terms, price action is a trading method that enables a trader to analyze the market and make decisions based on recent and current price movements instead of depending on technical indicators. But can you actually earn consistent profit by only using price action? Let's find out. In today's video, I'll share 3 simple yet profitable trading strategies that rely solely on price action. So without further ado, let's get started. First on my list is trading price action with support and resistance. Basically, in this strategy, we just need to draw key levels on the chart and we are good to go. Look at this chart. We can see that the price keeps moving downward, then after some time it moves upward. That zone where the bounce occurs is considered a key level of support. Now we wait for the price to return to this level. After touching the support area, it forms a bullish engulfing pattern and the price rallies upward. This creates a solid trading opportunity. So, how do we trade this? First, wait for the price to revisit the support level. Once it reaches that support, start looking for a bullish candlestick pattern. In this example, we have a bullish engulfing, so we will trade based on that. Place the entry at the candle close of the engulfing bar, set the stop loss at the lowest point of the support, and target profit at 2 times higher than the stop loss. And there you go, another successful trade. But keep in mind, guys, I didn't trade this simply because it bounced at the support and formed a bullish candlestick pattern. There is one more factor I always consider, and that is the size of the candlestick. Now look back at the chart. Notice as the price moves toward the support level, have you seen that the candlesticks are getting smaller? When the candlestick approaches the key level, make sure the candles are shrinking. This indicates that momentum is weakening, and that's exactly what we want when price nears a significant level. But what happens if the price approaches the key level with larger candlesticks? Take a look at this chart. We can see it produced 3 successful bounces from the support, but on the next attempt, it failed. Not only that, the candlesticks became larger as they neared the support level. This shows strong momentum driving the price even lower, and that's the scenario we want to avoid. Let me give you another example. Look at this chart. You'll notice it formed a resistance area after 2 successful rejections. Now it is moving back to that resistance zone again. As you can see, while approaching the resistance area, the candle size is shrinking. Once the price touches the resistance, it produces multiple hanging candles, which signal a loss of momentum, and this is where we plan to trade. After the series of hanging candles, a bearish engulfing candle appears, and that's the signal we want to trade. We place our entry at the candle close, set the stop loss at the highest point of resistance, and target profit at 2 times the risk. And just like that, we secure another successful trade. Always remember, guys, check the candle size before placing any position to avoid getting trapped by a false signal. So that completes the first strategy, but before moving on to the next, if you're enjoying this content, please hit the thumbs up and share your comments. I will show you how to trade using market structure. Market structure is made up of support and resistance, swing highs, and swing lows. But for this strategy, we will focus on trading swing highs and swing lows. First, let me explain what these are. I want you to clearly understand market structure, because it is the concept in technical analysis that you can rely on. No matter what time frame you enter, you can always identify these and use them effectively. Look at this illustration. In any trend, the market forms a sequence of highs and lows. In an uptrend, you can spot 3 highs and 2 lows before the market reverses. In a downtrend, you can observe 3 lows and 2 highs before the trend ends and prepares for a reversal. This makes it easier to understand. Let me give you an example. Look at this chart. You can see we have an uptrend here. After reaching the 3rd high, the price formed a bearish engulfing candle, which is a strong reversal signal. But we will not place a short position yet. We will wait for confirmation that the market is shifting into a downtrend. Later on, a doji appeared followed by a bullish candle, then a few candles later, the price printed a bearish candle showing strong downside momentum. This confirms we are indeed in a downtrend because the market failed to form another higher high. Now we trade the setup. Place the entry at the candle close of the bearish engulfing, set the stop loss at the previous swing high, and target the exit at the next bullish candle. Now let's look at a long position example. On this chart, the downtrend created a series of highs and lows, then completed the third low. After several candles, the price formed a bullish engulfing candle, which failed to make a new lower low. This bullish engulfing pattern confirms the market is shifting into an uptrend. We enter at the candle close, place the stop loss at the recent swing low, and target the next bullish candle. Here's a tip for all of you: keep practicing. Practice will train your eyes to recognize market structure more naturally over time. I'm going to show you how to make trading decisions using trend line breakouts. In a previous video, I shared different strategies on trend lines, and now we'll use that knowledge to spot opportunities in the market. Look at this chart. We can draw trend lines here. In this case, we'll apply the breakout and pullback strategy. First, we wait for a successful breakout of price, then wait for the price to retest the broken trend line. After that, we place a position using a bullish price action pattern. In this example, it's this hammer right here. We place our entry at the candle close, set the stop loss at the last swing low, and for our target, we measure the base of the channel and project the same distance as the exit price. And now we have a successful trade. Let me give you another example. Look at this chart. On this high, we can draw a straight horizontal line, then connect the lows to form a diagonal trend line. This creates a bearish pattern. For this setup, we'll again use the breakout and pullback strategy. Here, the price breaks out of the trend line with a massive candle. This is a strong breakout signaling downward momentum. Once we see the breakout, we wait for the price to retest the broken trend line. Notice that it forms an inverted hammer, which is a bearish candlestick pattern. We place the entry at the candle close, set the stop loss at the previous swing high, and use the base of the price pattern as the target. And just like that, we have another successful trade. Now, combining these three strategies together gives us high probability setups because they provide added confirmations. I've separated them into three individual strategies since they can also be used independently. This way, you gain a wider perspective and a deeper understanding of how each one works. As a beginner, you should first focus on mastering one strategy, then move on to the next, and so forth. Once you master all of them, you can combine them into a strong and balanced trade plan. Consistency in practice and learning is what will make you a better trader. Thank you for watching. Now, if you enjoyed this video, please hit the like button and subscribe to our channel so you won't miss any videos like this. Until next time, see you.